Hey everyone, and welcome back. Now today we're going to go over kind of a wider market update, but this is not necessarily a crypto specific market update. This is a macro market update. And the reason why I think this is so important for all of us to know is because as much as we may not want to believe it, the macroeconomic market really does pretty much depend what happens in crypto for several different reasons. We'll go into some of those reasons kind of as we go through the video, but ultimately this information is very, very important. And so if you're new, or maybe just you don't focus too much on the wider economic market, you just focus on crypto, I wanted to share some of the top key points of data that I think we should all be looking at as we're going through and trying to make a decision on where we're going in the crypto market. So let's go ahead and dive right in. Now, before we start talking about some of these more macroeconomic pieces of data, I did want to go over the charts that we have that we've been seeing in crypto. So as I mentioned in some of my last videos, I have basically started doing most of my charting within Margex just because they do have the TradingView plugin, and I have been trading pretty actively on Margex over the past several weeks. And so as we can see with Bitcoin, we did see this big drop down here. We can see that I did actually time the bottom almost perfectly with a trade. This one, full disclosure, I did get liquidated once because I tried to enter the trade here because this appeared to be the bottom, and then obviously this was the bottom. So that's just, when you do trade, it is very risky. You can lose. So if you do want to trade, just make sure that you're not trading with anything you can't lose, especially when you're trying to get the hang of things. Remember, if you're trading on leverage, you can take a 100x position on, $100, and I think that's like $1 worth of margin, right? But if it goes up 1,000%, that's $10. So granted, while the numbers may not be large, you can place very, very small positions just to get the hang of it while you're getting kind of up to speed and figuring out how it works. So as we can see here, my Bitcoin position is at 330%, and then I also got into an ETH one similar because ETH sold off even worse than Bitcoin did, and this one's up almost over 500% at this point. So these ones I do have stop losses put, I think, below this level. So I think my gains of about 200% are locked in, but I want to see just kind of how the market plays out because I do think there's a possibility we could get back up to here. So if you are interested, please check the link in my description below. You can get up to $10,000 in referral bonuses, as well as they are doing a $500,000 Caspa airdrop right now. So if you're wanting to get your hands on some extra Caspa, that would be a good way to do that. But overall, like I said, this is risky stuff. The market we are playing in is currently on hard mode. So just don't invest or trade with anything you can't afford to lose, because especially if you're new, there is a real possibility that you could lose it. So just be very careful if you decide to do that. So moving on, we're going to look at the SOM rule. And this is the first of kind of 6 major pieces of information that I wanted to go over, because all of these essentially impact the market, and historically at least have been leading bellwethers in terms of where the market is going and if it's predicting a recession. As you'll see through basically all of these, everything is pointing towards a recession, which I think is why there's so much fear in the market. However, the thing that we've talked about on the channel before, and I think something that's kind of a maybe well accepted fact by cynics at least, is that the market always moves in the direction of maximum pain, right? And so what we've seen right now, if everybody's expecting a recession, is it going to happen? Because everybody's seeing it coming, and that would not be the move of the most pain potentially. So anyway, that's just something I wanted to bring out. But as we can see on the SOM rule, essentially this is some calculation that was invented by I forget the person's first name. Claudia Sohm. That's her first name. So Claudia Sohm essentially invented this rule, which, as you can see, almost the gray pieces are like recessions. It almost perfectly has predicted every single recession in the past, right? So as we can see, this will predict it more times than not, but it has always predicted the recession, right? And so sometimes we've seen some false starts around here, but every time we have had a recession, this has gone off. So it does still kind of remain to be seen whether we're in a kind of a false start type of area, or if this is actually going to continue to rise up. I would imagine that the data over the next month or two will be pretty clarifying, because as we can see, it ticks above barely, which is what we've seen here, and then it kind of goes parabolic. So if we see the parabolic run, then obviously that will be pretty clear at that point. But right now, we don't exactly know for sure. The other thing that I want to talk about is it's called the yield curve, right? And so essentially it's the 10-year minus the 2-year. And usually you would imagine the 10-year is always going to pay you more than the 2-year because you're locking it up for a longer period of time, right? Well, that's not always the case, actually. There are certain times in the past we can see where it dips below this line where you actually would get paid more on a 2-year treasury than a 10-year. And the reason for that is because people are expecting uncertainty to come within the short term, so they're willing to take a lower rate to be essentially have their money secured for a longer period of time. And so what we can see is we have actually been sitting in a period of inverted yield curves ever since July of 2022. We did just barely see this start to pull out of that, and as we can see historically, when it uninverts, there essentially is very often been followed with a recession. So we can see that basically in all of the last 3 times, and then kind of in the 80s it was a little bit more confusing, but we did see that sort of follow, I guess. But so anyway, this is another thing that, obviously I think we should be looking at. We did just uninvert, so there is a lot of fear that maybe a recession is to follow. So that's just something to keep an eye on. The other thing is interest rates and price indexes, right? So essentially this is like the Fed funds rate. And as the Fed essentially cuts their rates, you can see it essentially is always in the middle of a recession because the Fed is cutting their rates to try and stimulate the economy, right? And as we've seen now, this is the expected interest rate for 2026 at this point is 3.1%. We are currently, I believe, at 5.5%. So if this were to follow the case, we would be expecting to see these rates at least have potentially, it could be better, it could be worse, but this is at least the current prediction, which again, would seem to indicate that we might be seeing a recession coming as well. So there's a lot of things, as you can see, they're all kind of lining up and showing the same picture. Additionally, civilian unemployment rate. Unfortunately, we don't have as much data here. This only goes back to 2004, so we really can only see the great financial crisis and the COVID crash. But what we can see is, it starts to tick up a little bit, and then boom, it goes parabolic, and then, it starts to come down over time, and then boom, goes parabolic again. And so what we can see here is that the rates are starting to tick up slowly, but we definitely have not hit that parabolic phase yet. And so it's possible that we could still be hitting this parabolic phase, but it's not necessarily a guarantee. So, this is something that I've also been taking a look at as well, is this is starting to tick up. I think the next thing to see within this would be a, kind of a more parabolic jump to maybe 7, 8, 9, 10% potentially even. So this is another thing that we should all be keeping eyes on as well, is just the unemployment rate, because this usually is kind of the indicator that produces the recession, obviously, right? Because people don't have jobs and can't spend money and they're struggling financially. So the other thing I wanted to look at, this is the last of the 6 pieces of information. I know we ran through all of these pretty quickly, but I wanted to provide as much information as quickly as possible so you can see all of the main leading bellwether indicators within the macro market. So as we can see so far, at least, they all are all kind of painting the same picture, and then, we'll wrap up with what this means for crypto. So as we can see here as well, this, again, I wish I had more data here. This only starts at 2007, but we can see up to the lead up of the great financial crisis, delinquency rates got really, really high, obviously during the middle of it, and then it started to come back down. Same thing within the COVID crash, and then they came back down. So what we are seeing now is we are starting to see this rise up again. To what degree? We actually are already higher than what we saw in the COVID crash, and this came down so low because of essentially all the free money that was pumped into the market, right? So this kind of makes sense as to why this came down so low, and this rise back up, I wouldn't say is necessarily a bad thing. It might even just be more of like a return to normal. If this continues to rise up into the 4 to 5% range, then we could potentially, be a little bit concerned here. So overall, these are kind of six key macroeconomic indicators that are all saying the same thing. And so what does this mean for crypto, right? As much as we may not want to believe it, crypto is very much dictated, at least in its current point, by the wider macro market. And so if the wider macro market comes into another Great Depression, that's obviously terrible for crypto. And all of us are not going to be very happy with what goes on, because crypto is what we would call like a risk on asset, right? And so it's more risky than putting it in a bank account, putting it in a CD, buying treasury bills, buying, I might disagree with that personally, but from the conventional wisdom, buying Bitcoin is more risky than buying T-bills. Again, I think most of us who are in crypto probably disagree with that, but I'm just talking about conventional wisdom. And so what that means is if you can go get a better rate or a safer rate, more importantly, somewhere else, this is going to impact risk on assets because they essentially thrive in riskier conditions, right? And so when people don't want to be risky anymore, it obviously does not bode very well for them because they need the low interest rates. They need the high amount of financial leverage. They need the like risk taking and speculation and some of the stuff that usually does not do particularly well in a bear market. And so some of these things obviously are flashing somewhat concerning indicators, but I do think, staying in line with kind of the 4-year cycle, we are going into rate cuts, right? And rate cuts are something that are historically very bullish for crypto. And so we may, it's hard to say. I think if we, get thrust into the next Great Depression, then obviously this is going to be horrendous for crypto. But as we saw with the COVID crash, that technically was a recession, right? It was a very short recession that was kind of maybe artificially induced, but it was in fact a recession. And as we saw after the COVID crash, when that week essentially popped out of that recession, crypto went nuts, right? And so this is just because some of these signs are starting to flash, it does not mean that we're going to go into the next great financial crisis where it's a 3, 4, 5+ year-long event, right? The Great Depression was like a 6 to 8 year-long thing. That doesn't mean we're gonna do that, right? A depression technically means it has had 2 consecutive quarters of negative GDP growth. So it could be technically a 6-month thing, bare minimum, right? It doesn't have to be a multi-year event. And so essentially, I think what we're going to see is coming out of that recession is when we would expect to see crypto go crazy. Or on the opposite end of that, the recession actually does not happen. People think, oh, well, it's different this time. All these risk-on assets go nuts, and then the recession comes around. I think if that were to be the case that plays out, the recession actually is much worse on that second option. But I do think those are probably the 2 most likely options. Again, this is my opinion. This is not financial advice. I have no freaking clue what's going to happen, just probably as much as you don't. This is just my guess based on the data that we're seeing and historically what we have seen in the past. So anyway, if you found the information in this video useful, please do give me a like and subscribe. It really does help me out. I know this was a bit of a different video today, but I do think it cannot be understated the importance that the macroeconomic environment plays within crypto. So I just wanted to kind of show you guys some of the main indicators that people typically look at when trying to assess the health of the market. So if you found that interesting, again, please do leave me a like and subscribe. If you have any comments, questions, concerns, anything, I do really appreciate all the feedback. So, please leave me a comment. I do respond to all of my comments. So if you want to just chat or, interact with me as well, feel free to leave me a comment. I will respond that way. So thank you for tuning in, and we'll see you in the next video.